is also important because it affects asset markets, the theme of this book. Chapter 3 describes stylized facts regarding long-running historical stock returns. The historical long-run returns to stocks have been amazing. $1 invested in the stock market 100 years ago would have turned into several $1,000s today. Stock markets are also risky, however. The chapter illustrates this by comparing stock returns to bond returns. Chapter 4 explains how stock returns can be decomposed into underlying drivers of stock returns: yield, growth, and valuation change. It also shows the relative importance of each of these components for historical stock returns. Part 1 deals with the long-run economic growth and stock returns one by one, leaving it to Part 2 to describe how they are related in the long run. Part 2: Economic Growth and Stock Returns in the Long Run. The second part of the book analyzes the relation between economic growth and stock returns in the long run. The long run means many years, for example, several decades. Table 1.3 illustrates Part 3. Chapter 5 describes why one should expect a relation between drivers of stock returns and economic activity in the first place. The underlying idea is simple. Stock prices are discounted dividends. Dividends depend on firms' profits. Profits depend on economic activity. The chapter shows that, in the long run, profits and stock prices follow economic activity. Chapter 5 illustrates the concepts and ideas using U.S. data. Chapter 6 discusses whether countries that have historically experienced high growth in economic activity are also countries that have historically delivered high stock returns. The conclusion is clear. The relation between economic growth and stock returns across countries is weak. Stock market returns have exceeded the rate of economic growth by a wide margin. On the other hand, the chapter shows that economic growth is linked to growth in stock prices and interest rates in the long run. Chapter 7 shows that the average annual return to equities has exceeded the average annual return to safe assets by a factor of 3 to 4. This difference is the equity premium. The fact that the average return to equity is so high has puzzled economists. They call it an equity premium puzzle. Scrutinizing what determines the equity premium will help us understand the conclusion from Chapter 6 that there is no clear relation between economic growth and returns across countries in the long run. Part 3: Economic Growth and Stock Returns During the Business Cycle. Part 3 examines the shorter horizon relation between economic growth and stock returns, the relation over the business cycle. The business cycle refers to recurrent shifts between contractions in economic activity, that is, recessions and expansions in economic activity. An expansion in economic activity starts at the trough of a business cycle, that is, after a recession. After some time, the level of economic activity reaches a temporary peak. The economy enters a recession, and then it all starts over. Expansions and contractions define the business cycle. Business cycle fluctuations are fluctuations in economic activity around the long-term growth trend. Part 3 of this book describes the business cycle and how it relates to stock markets. We will see that stock markets react strongly to the business cycle. Stocks do great when economic activity expands, but poorly when the economy contracts. The composition of Part 3 is outlined in Table 1.4. Chapter 8 explains what the business cycle is, how it is defined, what characterizes it, what causes it, etc. The chapter also describes the typical business cycle, that is, the duration of the typical expansion and recession, and how much economic activity typically contracts during recessions and increases during expansions. Chapter 9 examines the relationship between the business cycle and stock returns. We will see that business cycle fluctuations in economic activity have first-order impact on stocks and bonds. Stocks perform badly during recessions, but well during expansions. Chapter 9 also discusses bond returns. Bonds provide safe havens during recessions, that is, perform better than stocks during recessions.